Hello, and welcome to this introduction to AEOI. This is an introductory session assuming no prior knowledge of the subject, and will cover some of the basic objectives and principles of AEOI. With it being an introductory session, for the purposes of simplicity, I'm going to focus on the reporting of individual account holders and won't be covering entities, companies, partnerships, trusts, etc. will be in a later session. Before we start thinking about the details of AOI, it's worth spending a couple of minutes first talking about tax. Most countries around the world have a system of tax that taxes their citizens. And in many cases, countries will tax their citizens on their total worldwide income. So for example, I live full-time in the UK. I'm what's classed as a UK tax resident. And if I had income in different countries around the world, I would be required to report that on my tax return in order to ensure I was paying the right amount of tax. But how does the tax authority in the UK, how does HM Revenue and Customs know that I've declared all of my worldwide income? Well, this is where exchange of information agreements really come into play. Between tax authorities in different countries sharing information about tax individuals to tackle tax evasion and avoidance. Now, this isn't a new thing. Exchange of information between countries has been in place for a number of years, but historically that had often been on demand or on request in relation to individual taxpayers and individual circumstances. But the real game changer in recent years has been a move to automatic exchange of information, AEOI, where the onus is on financial institutions to identify overseas account holders and submit details to the tax authority each year. Let's have a look at an example. We had a UK bank that holds accounts for French individuals. It's required to report details of these annually to the UK tax authority, HM Revenue and Customs. The UK tax authority, HM Revenue and Customs, then share this information with the French tax authorities so that the French can check that the individuals have declared the right amount of income and paying the right amount of tax. The agreement between the UK and France is reciprocal, and similar requirements apply to French financial institutions. So for example, a French bank would need to report details of its UK account holders to the tax authority so that that information can be shared with HMRC in the UK, completing the two-way process of information exchange. In practice, AOI is not just about one agreement between two countries, because there are now over 100 countries that have committed to exchanges, and in total thousands of exchange agreements are now active across the world. Before we proceed further, it's worth just understanding the two key regimes that fall under AOI. AOI itself is an umbrella term that covers two key regimes. The first is FATCA, the Foreign Account Tax Compliance Act, and the other CRS, the Common Reporting Standard. FATCA is US legislation aimed at identifying US account holders. The CRS was developed by the OECD and is adopted by many countries that have taken it up. FATCA is focused on identifying US tax resident account holders. So for example, a UK bank under the rules of FATCA would need to identify its US account holders for reporting. FATCA was first introduced in 2014 and the first exchanges of information took place in 2015. The Common Reporting Standard, by comparison, is not about just one jurisdiction, but many. There are now over 100 jurisdictions that are committed to exchanging information under the Common Reporting Standard. So a financial institution under CRS needs to identify account holders that are resident in any of the jurisdictions that it's agreed to exchange information with to then submit the relevant reports. This was first introduced in 2016, and the first jurisdictions exchanged information in 2017. 49 to start with, which has grown since then to now over 100. Before we start looking at some of the practicalities of reporting under FATCA and CRS, it's worth just mentioning one key further point about FATCA. And that is that when FATCA was first introduced, many countries around the world entered into intergovernmental agreements, IGAs, with the US. These took one of two main forms. The first was Model 1, and Model 1 IGAs, the financial institutions submit information to their own tax authority. So FI in country A would submit information to country A tax authority, and then it's the tax authority that submits the information onwards to the US. By contrast, the other type of IGA, Model 2, and this also applies to countries that don't have an IGA with the US, details of any US resident reportable account holders are sent directly to the IRS in the US. There isn't an equivalent concept in the Common Reporting Standard. Under CRS, all of the reporting is similar to what we just saw in the Model 1 process, where the information is sent first to the financial institution's home tax authority to then exchange with other countries. It's worth remembering that many tax authorities now will be handling data for both FATCA and CRS. So they'll receive information from a financial institution, and then they'll need to send off details of the US reportable accounts to the US for FATCA, and then produce separate reports and send them to the relevant countries' tax authorities for CRS. So now we understand a little bit about FATCA, CRS, and what it's trying to achieve. How do financial institutions actually know which account holders to report? Well, this is where due diligence comes into play. And the due diligence rules that need to be applied depend on whether the account is new or pre-existing. Now, a new account refers to an account that was opened after the start of FATCA or CRS. And with a new account, the onus and much of the process is around self-certification. So when you go to open a new bank account, there are certain procedures you need to follow and certain information that's requested, and part of that is confirming which jurisdictions, which countries you are tax resident in. For pre-existing accounts that were opened before the start date of FATCA or CRS, the process is slightly more complicated because they may or may not have that sort of self-certification information. If not, then there's a process of reviewing for what's referred to as indicia, indicators that an individual might be resident in a particular jurisdiction. So evidence of residence, indicators like an address, telephone number in a particular country, standing instructions to transfer funds to a particular country, or a power of attorney held by a person in a particular country, all indicators, indicia of residence that would then need to be followed up by the financial institution to confirm by self-certification if that individual is indeed resident in one of those countries. We'll now move on to some of the practicalities. So once we've identified our account holders, we've been through that due diligence procedure, what are the practicalities of reporting? Well, in most countries, the reporting period is usually the calendar year, 1st of January to 31st of December, and the reporting will be based on the information about account holders for that year. That said, there are some countries that have a different reporting period, but most follow the calendar year, which is also the same for FATCA. Shortly after the year end, the first key deadline to remember is the 31st of March. And this is the deadline for FATCA Model 2 reporting directly to the US. Remember, this is the financial institutions that are sending their US reportable account data directly to the IRS in the US, 31st of March. And then shortly after that, between March and about July time, financial institutions will submit reportable data under CRS and FATCA to their local tax authority in time for the 30th of September deadline for exchanging information between tax authorities. So that would be for the Common Reporting Standard and submitting information to the US for FATCA Model 1 jurisdictions. So what is actually reported? Well, for an individual, it would be their name, address, the jurisdictions in which they are resident, the tax identification number or numbers that relate to those countries. So for example, this might be a social security number in the US. In the UK, the key identifier for an individual is a national insurance number. And in other countries, there'll be similar identifiers that identify the individual. Some countries don't have the concept of a tax identification number, in which case that wouldn't need to be supplied. In certain circumstances, the date and or place of birth is required. And there are certain rules about the date of birth sometimes not being required, particularly for FATCA purposes, and also the place of birth, sometimes certain rules about when that is and isn't required. I'm not going to go into detail of those on this overview session. In terms of the actual account details itself, it would be the account number or identifier, the account balance at the end of the year, and income credited to the account. Now, in terms of the definition of income, that can get quite involved depending on the type of account, and I'm not going to cover it in this overview session. So that wraps up this session, and as it's been a basic overview, I've concentrated really on individuals. I've not covered entities like companies and partnerships and trusts, and I've also not covered some of the details around definitions of financial institutions or financial accounts. They'll be covered in a later session. I hope that you found this useful. Do look out for further videos on our YouTube channel and also for updates on our LinkedIn and Twitter.